Do you realize the price of silver just hit a record $83.90 per ounce on December 28th, then plunged more than 10% in just hours the very next day? This was not random panic from small investors. It was not coincidence. It was a deliberate, orchestrated move. The third time in history they have used the exact same playbook at major silver peaks. If you own silver, gold, or have ever considered buying, what I am about to show you may first make you angry, but then it could help you make substantial money. If you walk away now, you risk missing one of the biggest opportunities the precious metals market has seen in decades, possibly pushing silver to $100 or beyond. I want you to picture this clearly. This is not a normal pullback. This is a textbook example of shaking out the weak hands right before a powerful rally begins. In the next 20 to 30 minutes, I will reveal exactly who caused this drop, how they executed it, why this is the third time they have run this script at major tops, and most importantly, the real plan unfolding right now that could drive silver far higher. Look back at the chart for clarity. Silver started the year around $30 per ounce. By December 26th, it broke $75. On December 28th, it spiked to $83.90, a 163% gain in months. This was not a meme-driven frenzy or short-term speculation. It was a sustained rally backed by genuine fundamentals, which we will examine closely soon. Then in mere hours, it crashed about 10%, wiping out weeks of gains. What happened? It caught leveraged traders completely off guard, triggering massive forced liquidations. Many think markets go up, markets go down. But no, this was intentional behavior by large institutions. Notice the silver ETF chart. It tracks price closely, though not physical metal. You see the engineered gap down, then a gap up to make it look normal. But watch this key line, resistance around $70. In the past 3 days, every time price pushed above $70, heavy selling appeared instantly. That is not random. It is the footprint of market makers and big players defending positions. And this pattern is not unique to silver. The same script repeats across stocks, commodities, major markets. Institutions quietly position first, then trigger moves that flush out the crowd. In this volatile financial year of 2026, with sophisticated manipulation everywhere, continuing to absorb deep perspectives from masters like Warren Buffett is not optional. It is essential. Their warnings about real value, spotting crowd traps, and protecting wealth amid engineered cycles serve as a steady guide through waves of illusion and panic. Missing them now means stepping willingly into a vulnerable position. As major shifts unfold day by day, now let us dive into the details. I will show you 3 historical instances where they ran this exact manipulation. How CME margin hikes are weaponized to crash prices, why physical silver demand keeps rising while supply shrinks, and specific strategies you can apply right now, especially if you are a U.S. retail investor, though anyone worldwide can benefit. And this time things are genuinely different, thanks to one very specific catalyst. That catalyst is the CME Group, operator of COMEX, the world's largest silver futures exchange. Even if you only buy physical silver, the price you pay is heavily influenced by futures prices on that exchange. On December 29th, right at the peak, CME sharply raised margin requirements. Let me explain simply. In futures trading, you do not pay the full value of silver. You post an initial margin deposit, for example, $20,000, to control silver worth $400,000. That is leverage. When CME increases the margin to $25,000, if you lack the extra cash immediately, a margin call is issued. You must add funds or sell. Most traders do not keep spare cash ready, especially during holiday periods. So they sell when thousands of positions liquidate at once. In low liquidity, prices crash instantly. Here is the key detail. This margin hike happened during the least active trading period of the year, between Christmas and New Year. Liquidity was nearly gone. Everyone was on vacation. That is how you engineer a lightning fast drop. CME claims it is about risk management and volatility. But if volatility was the concern, why not raise margins at $70? Why wait until the all-time high during the lowest liquidity window? This was not random, and it is not new. This is the third time this exact playbook has been used at major silver peaks. In 1980, rule changes drove silver from $50 down to $10. In 2011, silver hit $49. Margins increased fivefold in 2 weeks, and prices dropped 48%. Now, in 2025, silver reached $84. Margins doubled, and we saw a sharp decline. 3 peaks, 3 interventions, same pattern. To understand why this matters, go back to 1980, the most famous silver event in history, involving 2 Texas oil billionaire brothers, Nelson Bunker Hunt and William Herbert Hunt. They believed silver was severely undervalued. So they bought hundreds of millions of ounces physical and used futures to amplify demand. They nearly cornered the market. Silver surged from under $10 to over $50. London spot hit $54, equivalent to about $200 today. It was an insane level and a historic short squeeze. And they helped create. When authorities saw what was happening, they responded with overwhelming force. COMEX, today's CME, issued Silver Rule 7, only liquidations allowed, no new positions. Margins jumped to 50%, effectively eliminating leverage for new trades. The Federal Reserve hiked interest rates sharply, making funding any remaining leverage positions extremely expensive. Result, the Hunt brothers faced massive margin calls they could not meet. They were forced to liquidate. Silver collapsed from $50 to $10. That day became known as Silver Thursday. The Hunt family lost their fortune. Now see the clear parallels. 1980 had a massive run-up. Exchange, changed rules, forced liquidations, collapse. Today, massive run-up, margin changes, large-scale liquidations, sharp correction. In this volatile financial year of 2025, with sophisticated manipulation at play, continuing to absorb deep perspectives from masters like Warren Buffett is not optional, it is essential. There are warnings about real value. Recognizing crowd traps and deliberate interventions serve as a steady guide through waves of illusion and panic. Missing them now means stepping willingly into a vulnerable position as major shifts unfold day by day. And right now we are witnessing a similar cycle, but with more modern catalysts and global scale, and the same script repeated after 45 years. Exchange raises margins, forced liquidations, follow prices collapse. But this time the catalyst and context have changed completely. Fast forward to 2011, silver surged after the 2008 financial crisis, mostly driven by fear-based speculation. Then margins increased fivefold in just 2 weeks, and silver dropped nearly 50%. You may be asking right now, will this end the same way? Are we heading toward another major crash? The clear answer is no, because today's fundamentals are profoundly different. In 1980, the Hunt brothers tried to corner the market with massive physical accumulation. That was pure speculation. In 2011, demand came mainly from post-crisis fear, again speculation, but in 2025 what we see is structural industrial demand, sustained and long-term, not speculation by one group trying to control the market. This is a genuine multi-year supply shortage with inelastic demand, meaning demand does not drop even when prices rise. Why is demand inelastic? Because the modern world cannot function without silver. Silver is not just a monetary metal like gold. It is the planet's most critical industrial metal. With the highest electrical and thermal conductivity of any metal, silver is irreplaceable in key technologies. You cannot build green energy without silver. You cannot sustain the AI revolution without silver. You cannot mass produce electric vehicles without silver. Let us break it down by sector to see the perfect storm forming. First, solar energy, the largest and fastest growing industrial consumer. Solar now accounts for 29% of industrial silver demand. A decade ago, it was only 11%. Each solar panel requires about 20 grams of silver, mainly in conductive paste to convert sunlight to electricity. No viable large-scale substitute exists yet. Global solar demand is exploding not just for climate goals, but because the world needs vastly more electricity than ever. Artificial intelligence alone is driving unprecedented power consumption. Current forecasts suggest solar could consume 85 to 90% of all known silver reserves. By 2050, let that number sink in. One industry could absorb nearly all known silver in the next 25 years. Next, electric vehicles, the second biggest driver. A typical electric vehicle uses 25 to 50 grams of silver, and about 70% more than a traditional combustion engine car. Silver is essential for battery management systems, power electronics, charging infrastructure, and every related component. Automakers will not halt production lines just because silver gets expensive. They will pay whatever price is necessary to keep building. And the third factor, few mentioned in 2011, artificial intelligence. AI is not just abstract software. It demands massive physical infrastructure right now. Data centers, servers, cooling systems, connectivity, all requiring silver for efficient conduction and heat dissipation. In this volatile financial year of 2025, with sophisticated manipulation at play, continuing to absorb deep perspectives from masters like Warren Buffett, is not optional, it is essential. There are warnings about real value. The difference between short-term speculation and structural demand serve as a steady compass through waves of crowd illusion. Missing them now means stepping willingly into a vulnerable position as major shifts unfold day by day. And now, as unstoppable industrial demand keeps rising, while physical supply remains constrained, silver sits in a unique position, both a monetary refuge and an essential material for the future. Data centers, servers, power systems, all require thousands of high-performance electrical connections. Those connections rely on silver because no metal conducts electricity better. This demand did not exist in 2011. It was not there in 2020. It is a new demand stacking on top of solar and electric vehicle needs. Tech companies are racing to build massive computing capacity. Every new data center becomes a significant silver consumer. And now things get truly interesting. While the paper market and COMEX futures crashed, the physical market tells a completely different story. Look at the Shanghai premium. Normally, physical silver in Shanghai trades $5 to $10 above COMEX prices. Last week, that premium spiked to around $8. An extremely high and unusual level. What does that mean? Buyers of physical silver in Asia are ignoring paper prices and willingly paying more for real metal. This signals genuine physical silver shortage. The physical market is screaming, we need the metal right now. Meanwhile, the paper market pretends everything is fine. Inventory data confirms it. Shanghai silver stocks have dropped 86% since 2020. London vaults continue seeing steady reserve declines. COMEX inventories keep falling. At current levels, global exchanges hold about 30 days of usable silver supply. Paper silver prices can be manipulated temporarily, but physical supply cannot. The growing disconnect between paper and physical markets is unsustainable. Eventually, paper prices must align with physical reality, or the paper market loses all meaning. Now let us talk supply, because this is where the crisis becomes undeniable. The silver market is in its fifth consecutive year of supply deficit. For 5 straight years, demand has exceeded total supply. Cumulative shortfall is around 820 million ounces. For 2025 alone, estimates show a deficit of about 230 million ounces, equivalent to Mexico's entire annual production. One of the world's largest silver producers. The world mines roughly 800 to 850 million ounces per year. Recycling adds about 200 million ounces, total supply around 1 billion ounces, demand around 1.2 billion ounces. That gap is being filled by drawing down exchange inventories and tapping strategic reserves. But those sources are finite. They will eventually run dry. Why can supply not catch up? The mining industry has been underinvested for years because prices were too low. New mines take 8 to 12 years to start production. You cannot flip a switch. Most silver is a byproduct of copper, zinc, lead, and gold mining. Higher silver prices alone do not automatically boost supply, unless prices of those primary metals rise too. And here is the final shocking piece. China has restricted silver exports. Special licenses are required, and obtaining them is extremely difficult. Why does this matter? China controls about 60% of global refined silver supply. They are preserving domestic reserves for their own industrial needs. There may be political factors, but the result is clear: less silver available on the global market. Even Elon Musk has spoken out, tweeting that this is not good because silver is essential for many industrial processes, especially those he uses. When leaders in electric vehicles, solar panels, and AI infrastructure publicly warn about silver shortages, that is a signal worth paying attention to. Now let us tie it all together with one final metric. The gold-silver ratio. This ratio measures how many ounces of silver are needed to buy 1 ounce of gold. Currently it sits around 58.1. Historically and geologically, the natural ratio is closer to 15 to 17.1, reflecting silver versus gold in the Earth's crust. In 2020, the ratio hit 125.1, meaning silver was severely undervalued. Today, silver has caught up somewhat, but there is still significant upside potential. Silver is not expensive. It remains cheap relative to gold, relative to demand, and relative to what is coming. Why does this matter? Because there is a rule many overlook, the 80-50 rule for the gold-silver ratio. When the ratio is above 80, silver is considered historically undervalued, a strong long-term buy signal. When it falls below 50, silver becomes expensive relative to gold, often the time to take profits. Right now at around 58, it tells us two things. Silver is still cheap, and the potential for significant appreciation remains large. In this turbulent financial year of 2025, with sophisticated manipulation at play, continuing to absorb deep perspectives from masters like Warren Buffett is not optional, it is essential. Their warnings about real value, the difference between short-term speculation and structural demand, serve as a steady compass through waves of crowd illusion. Missing them now means stepping willingly into a vulnerable position as major shifts unfold day by day, and as unstoppable industrial demand keeps rising while supply remains constrained. And silver holds a unique position, both a safe haven asset and an irreplaceable material for the future. And two things stand out clearly from the current ratio. First, silver has already had a strong rally in a short time. Second, there is still substantial room for further upside. Let us look at it another way for clarity. If the gold-silver ratio simply returns to its long-term average, and gold holds around $4,400 per ounce, then silver would need to trade at about $129 per ounce. I doubt anyone watching who owns silver would be upset by that outcome. That is why many Wall Street analysts and precious metals experts remain optimistic about silver in the long run. Yes, silver has outperformed gold significantly lately, but now you understand why it is not hype. It is pure mathematics, supply and demand. So the real question for us, retail investors, is what is our plan? In my view, we are witnessing the final phase where the paper market controls silver pricing. Physical scarcity is gradually but surely taking over price discovery. Institutions know this. That is why streaming company stocks barely budged during the correction. Meanwhile, retail mining stocks were devastated. Smart money is not selling, it is accumulating. They favor physical silver and businesses with low fixed costs that give access to production. Meanwhile, leveraged retail traders have been shaken out, and That is the whole point. Fundamentals have not changed at all. So what happens next? I expect the paper market to remain volatile. Prices could become even more chaotic. There will be more attempts to cap prices through margin changes and futures pressure. Physical premiums, especially in Asia, are likely to keep rising. Chinese commodity prices may diverge further from paper prices due to export restrictions. But ultimately, real demand will prevail, as history always shows. In a moment, I will share a short clip from one of my mentors and a former market maker, explaining how these games really work from the inside and the kind of behavior you should anticipate going forward. But first, what can you actually do right now? That if this thesis holds, if physical silver ultimately dictates paper prices, the most direct and secure approach is owning physical silver. I believe the majority of your silver exposure should be in real metal. Some allocate gold and silver 50-50 or 60-40. Traditionally, many investors hold 75% gold and 25% silver. Personally, I think silver may outperform in the short to medium term, while gold remains especially strong for the very long term. How to buy? Use reputable large dealers. Focus on government-issued coins and bars, like American Silver Eagles, Canadian Maple Leafs, for higher liquidity and easier resale. For larger quantities, bars usually have lower premiums. Storage is critical. Keep it secure at home or in a trusted private vault. I do not recommend bank-safe deposit boxes due to access risks. And if storing at home, keep it discreet. No posting online. Be smart. Second strategy, streaming and royalty companies, names like Wheaton Precious Metals, Franco-Nevada, and Royal Gold. These are not miners. They provide upfront capital to mines in exchange for the right to buy future production at fixed low prices. Think of it as owning silver at wholesale prices. They tend to be less volatile than miners with predictable margins, and they avoid operational risks like drilling failures or budget overruns. Management cannot mess up mining. You just own the royalty. They are easily bought in standard brokerage accounts. Third strategy, top-tier mining companies. If choosing this path, focus on the highest quality, lowest cost producers. Names like Newmont, Barrick, Gold, Agnico, Eagle. They have strong balance sheets, diversified operations, low production costs, often around $15 per ounce of silver, and they typically pay dividends. Avoid small single project miners. They are extremely risky. Finally, keep substantial cash on hand. These engineered pullbacks will continue. The paper market can stay manipulated for a while longer. We may see broader economic downturns or bigger swings. Nothing is linear, so your job is straightforward. Educate yourself, make calm decisions, and think in years, not weeks. In this turbulent financial year of 2025, with sophisticated manipulation at play, continuing to absorb deep perspectives from masters like Warren Buffett is not optional, it is essential. Their warnings about real value, the difference between short-term speculation and structural demand, serve as a steady compass through waves of crowd illusion. Missing them now means stepping willingly into a vulnerable position as major shifts unfold day by day, and as unstoppable industrial demand keeps rising while supply remains constrained. Silver holds a unique position, both a safe haven asset and an irreplaceable material for the future.